Hi, assuming you've come to the right place, you're here to learn about accounting. Whoa, let's not get too excited now. We're going to take this one step at a time. Today, we will be going over some basic definitions, followed by an in-depth description of each of the three key financial statements that track accounting information. Feel free to pause this video at any time in order to let a concept either sink in or rewatch segments to make sure the concepts stick. So what is accounting? The basic definition of the term accounting is as follows. Accounting is the systematic process of recording, interpreting, and communicating financial information. So what makes it so crucial? Accounting provides managers with accurate, meaningful, and timely information, enhancing decision-making. The reason why so many small businesses fail is the fact that they do not effectively track their financial information, such as resources owned, cash generated, and profitability. Entrepreneurs end up neglecting accounting because they are too focused on day-to-day operations and their vision for their business. The hard reality is, without the numbers adding up, their vision will never materialize. Financial information is communicated through three key financial statements: the statement of cash flows, the income statement, and the balance sheet. Think of the cash flow statement as the master of cash. It tracks all dollars that move in and out of the company and when those dollars move, showing you how much cash should be in the company's bank account at any point in time. The income statement tracks your sales revenue and expenses associated with those revenues, showing you how much profit you're making. The balance sheet tracks all the possessions of the company, any debts taken on to buy those possessions, and how much the owners of the company have invested. I know that's a lot to take in, but we will now go into each sheet in more detail. Accountants tend to start with the income statement and balance sheet. However, the most important statement for entrepreneurs and small business owners is the statement of cash flows. While the income statement shows the company's profits, it fails to show you the cash available to the company, the cash on hand. The statement of cash flows reports the actual cash position of the company that is essential for its survival, because cash is king. So what is the statement of cash flows? It is a financial report that shows the changes in the cash position of a company over a period of time. The statement shows the difference between the cash inflows, the money received, and cash outflows, the money spent, which is the cash available to the company at any point in time. Let's move on now to the income statement. So, what is an income statement? It's a statement that shows the company's profits or losses over a given period of time. The main formula here is sales minus expenses equals profits. Expenses are all costs associated with day-to-day operations of the company, for example, wages, rent, and supplies. Expenses do not include asset acquisition. For example, if you purchase a computer for your business, that is not considered an expense on the income statement. If an expense is paid in cash, then it can simply be extracted directly from the statement of cash flows and moved on to the income statement. So when are expenses actually recognized? Expenses are recognized or recorded during the same period in which revenues are generated that are associated with that expense. So you might be thinking to yourself, what is the difference between net cash flow and profits? Net cash flow being something on the cash flow statement and profits being the final line on the income statement. Profits and net cash flow are usually not the same. Revenues or expenses are recognized when an invoice is sent or received, but not necessarily paid, and that's all on the income statement, while cash flow is only recognized when the cash actually changes hands, so when the cash is received by your company or the cash is paid by your company. Moving on now to the balance sheet. The balance sheet is a snapshot of the business's financial position at a specific point in time. It shows business owners the worth of the resources that they own, known as assets. It also shows the amount of debt they owe, which are known as liabilities. Lastly, it shows the owner's net worth and the value of their investments in the company, known as equity. The balance sheet is driven by the following formula. Assets equals outstanding debt, which is liabilities, plus owner's equity, which is the net worth of the owners. So what are assets? Assets are resources that are expected to help generate future revenues. Within assets, there are two categories, current assets, and then you have the fixed assets. Current assets are the resources that are expected to be converted to cash within the time period of 1 year. An example of that would be accounts receivable. Fixed assets are resources that are expected to last for more than 1 year. Property and equipment are an example of a fixed asset. On the other side, we have liabilities. Liabilities are the outstanding debts used to finance the purchase of assets. Within liabilities, there are two categories as well, current liabilities and long-term liabilities. Current liabilities, as you may have guessed, are debt obligations to be settled within 1 year. Accounts payable is an example of a current liability. Long-term liabilities are debt obligations to be settled in over 1 year. So these are longer-term loans. An example would be a bank loan. Last but not least, we have owner's equity. So what is this owner's equity? Equity is the current value of the owner's investment in the company in addition to the money earned and reinvested from previous periods. Assets has to equal liabilities plus owner's equity because any asset that is acquired by the company is either paid for by taking on debt, a liability, or by using an investment from the owner's equity. The balance sheet and the balance sheet equation make sure that every asset the company has is accounted for. At this point, you should have a pretty good idea of the general purpose of each of the three financial sheets. To show you a little bit more of a connection, on the income statement, the profits get moved over to the balance sheet under retained earnings, which is money that can then be used to further fund your business in the following years. From the cash flow statement, the cash available to the company appears on the balance sheet as cash. Also, it's that cash that results from the cash flow statement that allows you to buy further assets for your company that appear on the balance sheet. So what can a company do to ensure that it remains cash positive? There's several sources of external financing, but first, let's focus on internal. Working capital cycle management. Working capital is the sum of a firm's current assets less the current liabilities. Working capital cycle is the daily flow of resources through the company's working capital accounts. Current assets include accounts receivable, which are the results of sales done on account, which means purchased on credit. These include the amount of money the business is expected to receive from customers at some point in the future. Current liabilities includes accounts payable, which are the result of purchases done on account, once again on credit. These include the amount of money the business is expected to pay to creditors at some point in the future. To enhance a business's cash flow, one solution is to shorten the collection period of accounts receivable and extend the payment period of accounts payable. So basically you're saying people who buy things from you on credit, they need to pay you back quickly, whereas the people you're buying things from, like supplies, inventory, you're trying to negotiate longer terms so you don't need to pay them back as quickly so you have more cash on hand. Other than internal cash flow management, there's a couple other options for you to finance your business. Number one, there's debt financing. Debt financing is when you borrow money from creditors, like a bank. Money borrowed can either be a short-term loan, less than 1 year, or a long-term loan, more than 1 year. An example of a long-term loan is a mortgage. Your other option is equity financing, in which you give up a stake in your business in exchange for cash. An example would be you go knocking on Kevin O'Leary's door, you tell him, look, you give me $100,000, I give you 20% in my business. He probably tells you no and chases you down the driveway, but you get the point. The other source of equity financing is through retained earnings. Retained earnings are the profits from previous periods that are reinvested into the business instead of being distributed to the owners through dividends or another source. That concludes the Mindmap explanation of the 3 key financial statements. If you want to learn more and make sure that all those concepts have sunk in, watch the next video, which goes through examples of transactions and how those transactions affect the 3 different sheets.